I am very excited to welcome back Andy Schectman to the show as things just keep spiraling out of control. And it's just great to have Andy with us to walk us through some of the craziness. Welcome back, Andy.
Great to see you, Elliot. Thanks for having me, brother. I appreciate it.
Absolutely. So we have some interesting news. We have corruption at the biggest Wall Street institutions. First, we have, and you've been talking about this for a while, gold manipulation. JP Morgan gold trader turned whistleblower admits to lies. Trader's testimony key to U.S. spoofing trial of bank managers. Actually, to corroborate this, we have someone from Bear Stearns. Spoofing gold price common at Bear Stearns, the ex-trader says jury told of market manipulation before JP Morgan merger. So could you just explain what spoofing is and how they're manipulating the gold price?
Sure. Spoofing is a tactic by which traders will put on a very large trade on the market so that the other computers in the system from other banks and other brokerages can see this. In other words, let's just say they want the price to go higher. They'll put in there a bunch of trades, big ones that they're buying, and the other computers around the globe can see this. And then they will then react and maybe buy because their algorithms, they're not someone seeing this. It could be just a computer reacting to this. And then they pull it back at the last second. So it's highly manipulative and highly illegal. It is making trades fast, big ones, to make it look like the market is moving in this direction, either up or down, and then pulling them back before they execute. And it's very, very illegal. And it's been going on in this industry for a very long time. And, you know, as you mentioned, Bear Stearns. So it's important to understand that when silver went to $21, Bear Stearns went bankrupt, and because of it. And they called Jamie Dimon, that would be Hank Paulson at the time, the Treasury Secretary, into their office. And they said, look, we need you to take over the short position because they're now bankrupt. We need someone to take this huge short position over. We need you to bring the market under control. And Jamie Dimon said to Hank Paulson, and I guess it would have been Bernanke at the time, I believe, said, listen, if we take over your short position from Bear Stearns, we're going to be in violation of position limits. And so they said, okay, that's okay. We'll give you a certain amount of time to sell it off, like 90 days. At the end of 90 days, the then acting CFTC commissioner, the Commodity Future Trading Commission, his name was Bart Chilton. He came into his superiors and he said, JP Morgan not only has not pared down their short position as agreed upon, they've actually increased it. Now, he told this to Chris Marcus of Arcadia Economics. It's the only time Bart Chilton ever said that. He basically said that JP Morgan was rigging the market, was in violation of antitrust law and in violation of their agreement. And at that point, went to his superiors to say they need to be prosecuted, and was told to back down because it was a political decision. He died a week later. Now, I don't know if that's a coincidence. I'd like to hope it is, and not something more nefarious. But the bottom line is, Bear Stearns taught JP Morgan how to do this as their traders came over at that point was the largest short position in the history of the COMEX that Bear Stearns maintained. So when Bear Stearns folded, JP Morgan took it over. Some of those traders came over from Bear Stearns. The one guy that is being prosecuted right now is a guy that they basically joked about and said his fingers moved so fast on the mouse that they needed to put him in ice after because his fingers would have been, sprained. Point of the matter is that, yes, this was a very pervasive ploy or tactic that was used and taught from the traders at Bear Stearns who moved over to JP Morgan. And then it was going on all throughout the JP Morgan trading desk, as the traders are admitting right now. So, in fact, one of the guys on trial, his name is Michael Nowak. He was the head trader for JP Morgan. So if the head trader on the gold desk for JP Morgan is acknowledging this, how far up the ladder did it go? Did Jamie Dimon know that this was going on? This is the whole crux of RICO charges. Could it make it all the way to Jamie Dimon? I doubt it. He's pretty insulated, you would think. But the bottom line is that there are no free markets anymore, Elliot. There's just manipulations. And whether you're talking LIBOR, interest rates, precious metals, stock futures, the market itself. I mean, all of these markets are manipulated for a reason. And I think the more people understand that and the sooner they understand it, the better they will be. And let the manipulation of the markets work for you instead of against you. You have to first understand it, play within the rules that are out there, and hope one day the markets are set free to find equilibrium between supply and demand. And that is ultimately the goal. But until then, you play with the rules that are in the game.
Right. And that's why you believe in physical metal, because it's kind of outside of the manipulated paper market. But the biggest market that's manipulated is just the US economy, right? Because it's just based on money flow. And is the Fed increasing money supply or decreasing money supply? There's an interesting chart of Bitcoin is just 100% correlated with money supply.
And how about interest rates?
Yeah.
If you manipulate interest rates like they have and keep them ultra low like they have, it incentivizes people into speculation, which then pushes up the stock market. It pushes up property values because people can buy it more of a house than they otherwise would. What happens when they move rates up to 4 or 5 or 6 or 7%? You're talking the inverse relationship between all of these things that are considered wealth in this country. They start to move the other direction. And that's why you've seen this manipulation. And when manipulation ends, things are going to get frightening, because as rates rise, the pillars of wealth in this country are inversely correlated to that rise.
Yeah, absolutely. And so you have your finger on the pulse of the gold market, going back to it. Have you seen any manipulation on the COMEX? You did mention off camera that you had seen something odd happen there.
Yeah. So my whole career, the commercial banks, JP, Goldman, Citi, they're always the ones that are short on the COMEX market, always. And by extension, the managed money or the hedge funds are the ones that are always long, almost always. And so the managed money is bullish, and the commercial banks are trying to quell that bullishness by suppressing the price. And you know, it's a nonstop barrage of the commercial banks stymieing the market rise by they have deep pockets. So as the price rises, they can just keep shorting it, and they pickpocket the managed money's bullishness by driving the price down with their deeper pockets. So the largest commercial shorts in COMEX silver and gold have bought back more of their short positions over the past 4 months than any time in history, ever. And as a result, effectively hold the lowest commercial concentrated short position ever in the history of the COMEX market in gold, silver, platinum, and copper. And so this net commercial buying, sharp net commercial buying over the last 4 years has been over the last 4 months has been highly deliberate and orchestrated by the commercials. And some 60,000 silver contracts, that's 300 million ounces, have been bought back by the commercial banks. 170,000 gold contracts, that's 17 million ounces, have been bought back by the commercial banks. 33,000 contracts in platinum, that's 1.6 million ounces, and 67,000 ounces in contracts in copper, that's 838,000 tons. So what's interesting is that these purchases coincided exactly with the market failure in nickel on the London Metals Exchange to the day. So in essence, what has happened is that what I believe has happened is that when the nickel market failed on the London Metals Exchange in March of this year, gold was at its all-time high. When the nickel market failed, that's the first time in 140-year existence of the London Metals Exchange that they defaulted on a contract. That's very bad. And I think they basically said to these commercial banks who have massive short positions in gold and silver, many times that of the nickel market failure or the nickel market positions, they said, get your house in order. Because from that day, the price of gold and silver has dropped precipitously. And as it has dropped, the commercial banks have used the drop price to buy back their short positions. How did they do that? They slammed the price of gold and silver down, slammed it. And there's a chart that I would ask people to go look, and it's from the Office of the Comptroller Currency, the OCC. If you type in Office of Comptroller Currency or OCC and gold derivatives 2022, you'll see a chart where it goes back 12 years. It's got an orange bar on the right side. For 12 years, you see this much in the way of derivative positions. And then the first quarter of 2022 goes like this. So January, February, March. What happened is the commercial banks slammed the price of gold and silver, and the hedge funds, which are always long and bullish, got sick and tired of it and capitulated. So they did the dirty work for the commercial banks ever since, where they have been selling all of their long positions and in fact going short. And it's important to understand that this is pretty much a zero-sum game. When the managed money hedge funds sell or buy, the commercial banks take the other side of it. So the managed money not only sold all of their long positions to the commercial banks who took those long positions, but they actually put on a huge number of short positions, which means the commercial banks take the other side and go long. The commercial banks being the most sophisticated, well-funded, well-informed traders on the globe. The commercial banks set a bear trap. The commercial banks hoodwinked or did the ninjutsu move using the weight of or the momentum of the managed money traders and flipped them. So now all of a sudden, the commercial banks, which are always short, have the smallest short position they have ever had in the history of the commodity exchange. So my hope is that the signal, the failure of the nickel contract on the London Metals Exchange, which was a huge deal, the first time ever a contract has failed. Now, by the way, when a contract like that fails, when a trader places a massive bet and loses, the broker who brought that bet to the exchange is supposed to cover it. If that broker can't cover it, all of the members of the exchange are supposed to come in and fix it to make the exchange whole and to give it credibility. Instead of doing that, they said, it's too big, we're canceling everything. They made that short whole instead of bankrupting him. And all of the people who had bet on the other side that would have made lots and lots of money, sorry guys, trades canceled. It delegitimized the oldest commodity exchange in the world. And I think they said, you got to get your stuff in order right now or you're going to blow everything up, because the short in silver and gold is many times that of nickel, excuse me. And so maybe, just maybe, this time, the commercial banks are not going to short rising prices. And this is what makes the precious metals market so unique. Remember GameStop and AMC? All the traders were shorting it and driving the price down. You short a falling market, you sell into a falling market if you want to push the market lower. It is incredibly dangerous to short a market that is rising, because you're effectively selling with the intention of buying it back at a lower price later. That's the whole concept of a short position. You sell something here, you get money, and you intend to buy it back down here because you think it's going to drop. So you make the spread between here and here, where you sell it and where you buy it back. If you sell it with the intention of it going down and it goes up, it's the same thing as buying it hoping it goes up and it goes down. It's the inverse. So it's very dangerous. And the only people who have deep enough pockets that can pull that off are the commercial banks, who can keep shorting, keep shorting, keep shorting, keep shorting, keep shorting, and even have their cohorts at Bank of America and Goldman Sachs keep shorting, keep shorting, keep shorting. The price drops. The managed money gets screwed, and it's just rinse, wash, and repeat. And that's what would always happen over the years, is that the commercial banks would sucker the managed money into going long. Then they would short the rising market, drive the price down. The commercial banks sell, and then the process would go over and over and over and over. And the commercial banks would just pickpocket the managed money. It looks like maybe this time is different. They've never, ever, ever had such a small short position. They are effectively, when you look at the short position versus their long position, they are effectively long right now. Their long position is bigger than their short. I've never seen that. So you have the most sophisticated, well-funded traders on the globe who are now long for the first time I can ever remember, and have the smallest short position. By contrast, you have the greedy hedge funds who are massively short. And I'll tell you something, it's one of these deals where the commercial banks are almost never on the wrong side of the trade, because they have the information and they have the deep pocketbooks. They know where all of the hedge funds are positioned. They know the pain threshold. They know so what's going to happen this time is one of two things. As the price rises, either the commercial banks goes right back to their old tricks and short the rising market, or maybe this time the market failure in nickel was a wake-up call. And instead of shorting it, they actually add to their lungs. They'll blow up all the hedge funds. They'll go bankrupt. And the price will shoot to the moon as those hedge funds quickly try to cover. And hedge funds are more interested in immediate return. If they start losing as the price is rising, they won't dick around, and they will not sit around and wait for them to go bankrupt. They'll start covering. Covering means buying back those short positions. And that means the price goes to the moon with rocket fuel.
That is so incredibly exciting. I love hearing that. You don't want to spit into the wind, which is in this case, the powerful commercial banks. But if they're incentivized to make the market go up, then it's just a perfect storm, especially because if you look at the 1970s, which we're in a stagflationary environment, back then the gold price just absolutely skyrocketed. We're in one now. I mean, the fundamentals are setting up for a
And what happened before that? What happened several months before gold skyrocketed? It had actually gone way down.
Yeah.
And so that's how markets work, in the respect that the bull wants to take as few people along for the ride as possible, do everything in its power to buck you off and hurt you. And if you're on the right side of the trade, you're not on margin. And that's why it's better to buy it physically. And you have real strong fingertips and can trust your conviction and your belief, you get taken for the ride. And that's why so few people ever do it, because ever are along for the ride. They're reactionary. They don't have strong fingertips. They buy on margin or whatever it may be. And that's why buying physical, putting it away, understanding where the market ultimately is going to go is how you win. And I think when you see what is a really, I mean, I've done this for 33 years. I've never seen a market set up like this ever. We've always been fighting the commercials, and the commercials, which you could argue JP and Goldman are extension of the government. They have been incentivized to keep a lid on the price of gold and silver because it represents the canary in the dollar gold mine. And if gold and silver are going to the moon, it says there's weakness in the dollar. Well, I think playing these games is coming to an end, and the market failure in nickel was the wake-up call that the banks needed to realize that.
It's so unbelievably huge to hear that. It's just so exciting. Yeah, because these guys don't lose money, and it's all manipulated. So you want to be on their side when you're trading like this.
And I want to say one thing also. Remember at the beginning of the story, I was telling you about Bear Stearns. Bear Stearns went bankrupt because they bet against silver, and it went from 9 to 21. And if your listeners go and listen to Chris Marcus's interview with Bart Chilton, he admits this. He admits it. Yes, they went bankrupt. We called Jamie Dimon in and we asked him to take over the position. Position was in violation of position limits, yada, yada, yada. But the point of it is he admits they went bankrupt. And that's why the traders from Bear Stearns came over to JP Morgan, taught them how to do the spoofing. It became pervasive. And now these traders are facing many, many years in jail. These traders were saying that each one of them did between 20 and 50,000 of these spoof trades. They were screwing the market for years. And let's hope that they get what is coming to them, because it's no big deal to harm all of these people involved in precious metals, from the miners in South Africa down to you and I who own gold and silver in our vault or in our safe or in our pocket, whatever it may be. It is not the way free markets are supposed to work, and I hope that they get what's coming to them.
Yeah, and you use the manipulation to your advantage. So it seems like they want to cause the mother of all supply crunch short squeezes, which we seem to be setting up for.
That's what they have done. They have set the managed money up for that bear trap, the mother of all supply. That's exactly right.
Yeah, wow, that is incredible news for gold holders, especially physical gold holders. So do you have an update on kind of the geopolitical de-dollarization that we've been covering?
Yeah, so we've talked a lot about that, right? And we've talked about the ramifications of Saudi Arabia being protected by Russia, by Nigeria. It's migrated into Saudi Arabia selling their gold to Nigeria selling their gold to China for the yuan-denominated bond that is immediately convertible into gold on the Shanghai Gold Exchange. We've talked about now Saudi Arabia is contemplating that. Just the other day, Saudi Arabia came out and said, we are in negotiations and are going to most likely join the BRICS nations. Well, I mean, that's about as big as it gets, right? We got the other day where Turkey's president came out and said that they're going to buy Russian energy and do imports with other currencies other than the dollar. We had India just come out the other day, which is where the US is their largest trading partner. Now we're going to allow all domestic trades to be settled in rupee now, not in dollars. We are seeing a massive de-dollarization. We saw China dumping $100 billion worth of treasuries. It was just announced over the last 6 months. So we are seeing this concerted effort to move away from the dollar. And, you know, when you see these things start to happen like in succession, faster and faster and faster, when I started talking about Saudi Arabia being protected by Russia with you in September of last year, and we've talked about it quite a bit, never in my wildest dreams would I have believed that in less than a year they would join the BRICS or in discussions to join the BRICS. When you put the BRICS nations together and then add all of the countries that are joining, like Iran and Venezuela and now Saudi Arabia, Turkey is talking about joining, all of these countries joining, you're talking 80 to 90% of human population coalescing to a new system away from the US dollar. You want to talk about the height of bearishness for the dollar. Ultimately, this is exactly what it is. And I find it interesting to also note, on a side note, you know, all of these countries have been buying gold incessantly for the last few years, and you never hear about the US gold stocks increasing, right? Our gold stocks have stayed at 8,300 metric tons forever. But you got to wonder, where did the Libyan gold go? Where did the Iraqi gold go? Because it was just announced yesterday or the other day that the Ukrainian central bank acknowledged that $12 billion worth of its gold was sold in order to fund the war with Russia. Well, who took that gold? Where the hell do you think that gold went? Are we taking it quietly? Is that our way of accumulating gold? Because we know that when the system resets, that gold was revalued tier one, that all of these countries are massively accumulating gold, that we need to have a seat at the table too? I would argue most definitely. So anyways, the trend of de-dollarization is accentuating and accelerating. And you can see it even from people or countries that were our allies, like Turkey, like Saudi Arabia. Now, you can say we have kind of lost the ally status with Saudi Arabia, or maybe not, but certainly not as buddy-buddy as we used to be. But you are beginning to see all of these countries move away from dollar settlement and coalesce in a group which can't be bullied by the US. When you talk about the BRICS nations, Brazil, you have China, Russia, and India. The three linchpins are all nuclear power, nuclear weapon owning countries. We're not going to mess with them. So I don't know. I think this is very, very frightening, and it's accelerating. When you and I were talking about this 6, 7, 8 months ago, it was interesting. Now it's becoming very concerning as the acceleration of the de-dollarization is continuing.
Yeah. Hey, if you want to fight the kind of top dog, then there's strength in numbers. So like,
that's exactly right.
And so they're going to realize that, and there's going to be serious clout there. So, wow. Well, thank you for that update. Super excited to own some physical metal and all this. Like, I just love being on the right side, you know, with the big market manipulators. You know, you buy when they're buying. So very exciting. Where can other people go to buy physical metal if they're interested?
Sure. So, you know, our new website where we will have a early warning investor landing page should be done in August. In the meantime, we would ask your listeners to send us an email and in the subject line, put early stage investor sent me to info@Miles-Franklin. And we will send a updated price sheet. We will answer any questions. We'll have a broker contact or myself contact the clients directly. We'll make sure they get the very best price in the country. And just send an email, info@Miles-Franklin, early stage investor sent me, and we'll make it worth their while. We'll give your listeners the best price, personalized service from probably the only major licensed and bonded precious metals company in North America in an industry that's federally non-regulated. So Elliot, I love our conversations. I appreciate them. And I'll look forward to picking up with you where we left off.
This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decision. Investments are risky, and you can lose lots of money in them.